All right, let's get right to it. Today, we're doing more than just looking at a chart. We're essentially building a masterclass. We're going to put together a disciplined, professional-level playbook for trading one of the most talked about and, frankly, high-risk stocks out there, NIO. So let's dive in.
This is the big question, isn't it? For any stock like NIO, this is what everyone's wrestling with. Are you looking at a massive turnaround story, a huge buying opportunity? Or is this just a classic value trap ready to eat your capital? Well, the answer, funny enough, has less to do with the stock and everything to do with your plan.
And that right there is the core idea for our session today. When you're playing in the world of volatile, speculative names, winging it, well, that gets you nowhere fast. Having a predefined, logical framework is the only thing standing between a smart, calculated risk and just a reckless gamble. It's not just important, it's everything.
So here's our game plan for this discussion. We're going to start with the big picture dilemma that NIO presents, then get our feet on the ground with a hard fundamental reality check. From there, we'll build out two totally distinct trading plans. Plan A, the conservative one, and Plan B, the aggressive one. Then, we'll talk about how you choose which path is right for you, and we'll wrap it up with the most important rule of all, managing your risk.
Okay, let's be perfectly clear about what we're dealing with. NIO is a textbook turnaround play. The potential for a huge reward? Oh yeah, it's absolutely there. But, and this is a big but, it comes with some serious underlying risks that you just can't afford to ignore. Getting your head around this two-sided coin is step one.
Now, before we even dream of hitting that buy button, any professional trader grounds their strategy in cold, hard facts. So let's put on our analyst hats for a minute and do a quick, no-nonsense reality check on IO's current fundamentals.
So what is this stuff actually telling us?
Well, negative earnings per share and a negative PE ratio, that's simple. The company isn't making money right now. The Zacks rank, which is a pretty respected system, is giving it a hold. That's a shrug, not a thumbs up. And maybe the biggest tell of all, the folks on the inside, the executives, they aren't snapping up their own stock. You put all that together, and you've got some pretty bright red warning lights on the fundamental dashboard.
So this is the bottom line. If you are a strict, by-the-book, fundamentals-first investor, the professional conclusion is incredibly simple and sober. The right move today is to wait, not buy. You wait until you see the losses shrink, until there's a clear road to profitability. But what if you're not a pure investor? What if you want to trade this thing as a speculation?
Well, that brings us to our first real strategy, Plan A, what I call the conservative entry. This is the patient person's game. This plan is for the trader who says, show me the proof first. I want to see confirmation that the tide is actually turning before I put my money on the line.
The main idea here is what's known as a breakout entry. See, instead of trying to be a hero and catch the absolute lowest price, you wait. You let the stock prove to you that it has strength by breaking above a recent price ceiling, a resistance level. Basically, you're only buying once you see that other buyers are already showing up in a big way. And this table shows you exactly how that would work. Notice, the entry isn't now. It only gets triggered if the price breaks out above that $6 to $7 zone. Your stop loss, your escape hatch, is set about 15 to 20% below that, defining your exact risk. And you've already got your profit targets planned out ahead of time. It's all mechanical, no emotion.
So, to wrap up Plan A, you're making a conscious trade-off. You're willing to pay a higher price in exchange for a higher probability that you're right. You totally accept that you're going to miss the very beginning of the move because you want that confirmation that a real move is actually happening. It's all about patience and playing the odds.
Okay, so what's the other side of the coin? Let's talk about Plan B, the aggressive accumulation. Now, this is a completely different animal. It's designed for a trader who has a much higher tolerance for risk and who understands that they are buying into weakness on purpose. The core idea here is the accumulation zone. Instead of waiting for a breakout, you're actually buying into the current low prices, betting that the bottom is either in or very close. You are explicitly saying, I know the fundamentals suck right now, and I accept that I might be too early to the party. So here's that playbook. Your entry zone is basically now between $4 and $5, maybe buying in a few small pieces. But listen, the single most important number on this slide is that hard stop loss around $3.50. If the price breaks below that level, the idea is wrong and you get out, period. No questions asked. The potential reward is bigger, but so is the initial risk. The philosophy for Plan B is simple, but it takes a ton of discipline. Number one, you have to trade small.
Number 2, you have to fully accept that you might be wrong and the stock could keep falling. And number 3, you must respect your stop loss. That part is absolutely non-negotiable.
So there we have it, 2 complete, logical plans, Plan A and Plan B. So the question becomes, which one is for you? And this isn't about which plan is better, it's about which plan actually fits your personality as a trader.
This slide really lays it all out. You need to be honest with yourself. Are you the person on the left, or are you the person on the right? If you care more about probability and want that confirmation, you're a Plan A trader. If you've got a high risk tolerance and a 25% loss on a small trade doesn't make you lose sleep, then maybe Plan B is a fit. Only you can answer that.
And that brings us to our final and without a doubt most vital lesson. It doesn't matter which plan you choose, none of it works without this. Your success or failure in trading isn't decided by where you buy. It's decided by the risk management decisions you make before you ever even enter the trade.
The single most important decision you will ever make is your position size. I'm going to repeat that. It's not where you buy, it's not where you sell. It is how much you buy. And you calculate that based on one thing and one thing only, the exact dollar amount you are comfortable losing if you're wrong and your stop loss gets hit.
Here's the exact process, step by step. 1. Decide on that dollar amount you're willing to risk. 2. Use that number to figure out how many shares you can actually buy. 3. Predefine all of your exits, when you'll get out for a loss, when you'll take profits, all of it. And 4. Always remember what this is. It's a speculation. It's not a core long-term investment. You have to stay true to that framework.
So, we've built the playbook. We've laid out 2 very different paths and the universal rules of risk that you have to follow. The structure is all here. The final question, though, that's for you to answer. Now that you have this framework, how are you going to define your own personal rules of engagement?